is the countdown to the open. I'm Matt Miller, and for my good friend Jonathan Farrow. Moments away from the start of trading, we're looking at big drops on S&P, NASDAQ, and Russell 2000 futures after the Fed gave us a slightly more hawkish pause, I should say, than we anticipated. There you hear the opening bell. Trading starts right now. Let's take a look at some of the other asset classes here. Switch up the boards for me, if you would. The euro dollar right now at 106.54, and a lot of currencies falling against King dollar this morning after that Fed hawkish pause. The 10-year yield kind of off to the races, off of its highs for the session, but still at the highest level that we've seen since 2007 at 447.18. And NYMEX crude, which shot up at the end of last week, the beginning of this week, hasn't been doing a whole bunch since then, still hanging around $90 a barrel for West Texas Intermediate and under 95 for Brent. We do have one stock that we want to watch closely at the open. That is FedEx. Those shares rising after the Courier boosted its earnings forecast. Citi saying the company's performance is, quote, quite encouraging, and guidance is reasonably conservative. Abigail Doolittle joins us now with more. Abby?
Well, Matt, yes, a very solid quarter here from FedEx, and right now the shares are on pace in this difficult tape for the best day since June of 27th, up for a third day in a row, the best day since the middle of July. So we have some strength here for FedEx. The fact that it was trading higher into the report suggests that some investors are not entirely surprised by the fact that they beat, and they also raised the lower end of their guidance. It's interesting because UPS on the year down more than 10% or thereabouts. FedEx up more than 45%. So they're continuing to take ground from UPS, suggesting that UPS's weakness and issues is more UPS specific. What investors are also really pleased about here with FedEx is the fact that they, are really the $6 billion worth of cost cuts that's really dropping to the bottom line, or it will in the future. Again, they raised the low end of the guide. Lots of price targets raised on the street, and overall, Matt, this is just again a really solid beat and raised quarter. Investors rewarding the stock, the company, despite these difficult trading conditions. Yeah, and also, I mean, a huge barometer for the economy as well. So always fascinating to look at FedEx and UPS earnings as well. Let's get to that breaking news that Abigail was talking about a little bit earlier in the program. Fox and News Corp stocks fluctuating after news that Rupert Murdoch, their 92-year-old chairman, will step down and pass the baton to his son, Lachlan. Katie Greifeld joins us with more on this developing story. Katie?
Well, Matt, yeah, like you said, this is breaking huge news in the media space. Rupert Murdoch stepping down as chairman from both the Fox and the News Corp boards, moving into the chairman emeritus position and making way for his son, Lachlan Murdoch, to become the sole chairman of News Corp, in addition to his roles as executive chair and chief executive officer of Fox. Now, in a statement Thursday morning, Lachlan Murdoch congratulated his father on, quote, a remarkable 70-year career. Of course, Rupert Murdoch, aged 92, he built what is now a global media empire over the course of those decades. You take a look at the shares right now fluctuating. We can go ahead and call that unchanged. And let's check in on some other media movers this morning, Matt, since this news lands as the writer and actor strikes grind on over in Hollywood. Warner Brothers Discovery and Paramount shares, though, slightly higher this morning. The Writers Guild and the Hollywood studios said that they would meet for a second day, maybe a sign that these two sides are inching closer to a deal.
All right, interesting stuff on Rupert Murdoch. We're going to continue to cover that story. Still, he is younger than the chairman and CEO of Berkshire Hathaway. Let's talk about IPOs starting to lose some of their luster. ARM falling below its IPO price of $51 a share. Its fifth consecutive day of decline. Simone Foxman joins us now for more. So we're seeing, Simone, pops that essentially dissipate rather quickly.
Yeah, I mean, we have to wonder at this moment if some of the sheen has come out of this IPO market, because all of these IPOs, ARM, Instacart / Maple Bear, Klaviyo, were oversubscribed to begin with and closed substantially higher than their IPO price. But we're looking at ARM, again, priced at $51 a share, now $52.30-ish. Instacart priced $30 a share, now about $31, and Klaviyo close to $32 a share after pricing at $30 a share. So we're a little still above those initial IPO prices, but we definitely saw some weakness in yesterday's trading, especially as we got that news from the Fed, that Fed decision suggesting higher for longer, when the juice really came out of the S&P 500. Now, part of this could be analyst driven as well. The banks banks that were involved in this IPO still in quiet periods, and Instacart, the initial analysts coming out with some very lukewarm takes on how that company will do amid competition. Only one buy rating at the moment, even for ARM. It has 2 holds and 1 sell rating. But certainly there are lots of companies who've been maybe thinking about staging their initial public offerings soon, that are watching how these companies are performing over not just today, but over the next couple of weeks, looking for some indication of whether it's a good time or not to get into the market map.
I believe, by the way, it's pronounced Klaviyo.
Klaviyo.
They do software as a service for back-end application programming interfaces. Simone, thank you very much for that. Now, some big news in the networking space and software space this morning. Cisco agreed to buy cybersecurity company Splunk in a $28 billion deal. Meanwhile, Broadcom shares under pressure after a report that Google is considering dropping the chip supplier. It's going to design its own chips in-house. Ed Ludlow joins us here from the West Coast for the week. More on the tech sector. Ed?
Yeah, $157 per share in cash, a $28 billion deal. This is so in line with Chuck Robbins, right? A networking gear seller like Cisco adding the software services in complement to that. Splunk is a data indexing business. Basically, you can monitor network users in real time. It has a cyber security element. For those investors or Cisco and Splunk investors out there, this deal will not impact Cisco's previously announced share buyback program. Splunk CEO Gary Steele is actually going to join Cisco's executive team and report into Chuck Robbins. That's a big piece of M&A. Shares reacting negatively, but I would say most sell-side notes that I've seen are pretty positive on this deal. The information is reporting that Google will drop Broadcom as soon as 2027 for its proprietary silicon AI chips that go into data centers. Broadcom is an AI play in the sense that it offers what we call ASICs, application-specific integrated circuits. So if you think about an NVIDIA H100, that is a GPU that it has multiple use cases but can handle lots of data in parallel. The TPU that Google wants to use in its data centers is for a very specific AI workload. And what the information is reporting is that, according to a person familiar with the matter that they did not name, is that Google thinks it can save money and just design the chip itself in-house and then go away and have it contract manufactured. So this is an interesting deal. Google's been working on this TPU since 2016 with Broadcom. Now, according to this report, it seems like they want to go it alone, and the shares are reacting as such.
By the way, is this a trend? I mean, Google thinks it can save not just money, but billions of dollars, right? On the other hand, they don't have the experience and the years behind them that Broadcom has doing this. We've seen Apple pull back a little bit on its plans to do stuff like that in-house. Is this a trend that these tech companies are realizing they can't do exactly what the chip makers do, at least not at that pace?
In very specific cases. So what Apple pulled back from was the modem that Qualcomm does, the specific short distance connection. On the processor side, Apple is fully pushing ahead with its in-house silicon. It has the cutting edge of 3 nanometer smartphone processor, designs it itself in TSMC, contract manufactures it. It's a similar story with the Google TPU. There are many AI-related chips on the market, and we've talked about NVIDIA H100 being the best. But if you can control the design, find the contract manufacturing partner, then you can get yourself a higher margin processing for your data center. You can control the compute and energy efficiency, and that seems to be their direction. Not just Google, Amazon is doing it as well, right, with AWS. They have 2 generations of proprietary chip.
Ed Ludlow sorting us out there, and you can catch his program every day at noon, Bloomberg Technology with Caroline Hyde. Now, Wedbush posing the question, can tech stocks rise in a higher for longer landscape? Analyst Dan Ives, a noted bull, writes, now is not the time to become scared by the Fed. Stronger fundamentals and rate cuts on the horizon will create the start of a risk-on environment with the new tech bull market kicking off. Now, he's a bit of a cheerleader there, but one that we respect and love. But let's continue the conversation with Lori Calvasina of RBC Capital Markets. Lori, obviously Dan is very bullish, but higher rates historically not great for growth in tech companies. Is it a problem this time?
Well, thanks for having me on as always. And look, I think the question of whether or not it's a problem is a question of your time horizon, and also a question of what else is going on for tech stocks at the moment. One of the things that we see when we look at the growth trade broadly right now within the big cap landscape is that growth has been extremely crowded. If you look at CFTC data on NASDAQ futures positioning, and if you look at growth relative to valuations on a weighted multiple, so taking into account, kind of giving extra heft to those bigger mega caps, but we've basically been around recent peaks in terms of that relative valuation, and it's starting to come down. We're also starting to see the positioning correct, but we've still got a long way to go. I actually like tech longer term. I'm keeping my overweight on. We do those calls on a long-term kind of 12-month view, but we're acknowledging that there are some tactical problems here. And so you take that crowded overvaluation situation with the growth trade and you slap on all this talk of higher for longer, it gives you a catalyst to rotate out of something that probably needed to take a breather anyway.
So, but you think longer term tech can survive higher for longer. What if we don't get the soft landing? What if we get a recession that results in deep cuts? Is that bad for tech because the economy slows down, or is that good because rates come back down?
I think it's actually more good than bad longer term. Again, you have to get through this initial problem with the tactical concerns. But what we've typically seen is that when GDP is running in real terms below 2%, that is typically when the growth trade is outperforming the value trade. Stocks have essentially taken on a quasi-defensive role in portfolios these days. And if you think about sort of the market cap of the traditional defensives, they're just not as dominant as they've been in the past. And so what we do see is that when you're in these subpar economic growth periods, that people rotate out of the more value cyclical oriented parts of the market and into not just the defensives, but the growth areas as well. So if you think about, sort of the Fed commentary we got yesterday, they're still anticipating, they're baking in the soft landing, right? But they're saying GDP is still going to be sluggish and below that 2% mark for quite some time. Longer term, that is still a good setup for growth. So, and tech stocks are a big component of that growth trade.
What are the tech stocks, what are the tech sectors specifically that you like the best right now, Lori?
So I'm still intrigued by semiconductors. If you look at earnings revision trends, it's a very good for when you want to get in or out of that space. And we basically had trough-like earnings revisions within semis last year, and they've started to run. We're about kind of halfway through an upward revision cycle. We're not back to peak-like upward earnings revision trends, which is typically a sell signal to get you out of that space. If I look at software, by contrast, you've had earnings revisions that have been quite strong for quite some time. So we're not really seeing, kind of that mid-rebound. I think the fundamentals on the software stocks are very intriguing longer term, but you don't have that sort of short-term earnings revision recovery dynamic, that makes the semis look pretty interesting.
I was just talking to Ed Ludlow about this, Lori, and it seems like, at least in pockets, we see, Apple kind of admitting we can't do everything that the chip makers can do in-house, at least not as quickly. We saw that today in a sense from Google, or actually we saw Google say they're going to do that and maybe back down on it later. Do you think that's the case?
I don't know if I can get that granular into that particular debate, but I do think semis are essentially the backbone of the new age economy. And, and to a certain extent, they are commoditized, but in certain sense, you do need a real specialization. So, I would still look at the semis themselves, to be honest.
In terms of M&A, we had a big deal this morning that Ed was talking to us about. M&A, though, has been slow. IPOs had been slow. Is that turning around now that we see more people coming to market and some deals getting done?
It's interesting. I used to cover the small cap space, and you kind of think about IPO markets and small cap performance going hand in hand. And I was listening to sort of your show earlier today where you're talking about sort of these pops in the IPO market not really sticking. I could have very easily written that about the small cap space and the attempts to sort of bottom and start to outperform large caps over the last few months. I mean, the small caps are just sort of a good gauge, for kind of risk on behavior, I think similar to the IPO market. And we've seen just a series of failed attempts in the small cap space to really just kind of break out and rally. And longer term economic concerns, the idea that the market is not quite done with this, maybe we're just delaying the recession instead of avoiding it, has really, cast some doubt on the small cap space. I think the other thing, for sure the riskier parts of the market is pushing out some of the Fed cuts, reducing some of the Fed cuts for next year. I've always been telling people small caps are really dependent on getting rate cuts as a potential catalyst coming in here. So I think, that was not such good news yesterday necessarily from sort of a risk perspective.
And as a result, we see the Russell 2000 underperforming the other indexes. Lori Calvasina, always great to get time with you. Thank you so much for stopping by. Lori Calvasina there of RBC. Coming up, Q3 earnings cycle starting to ramp up already.
The earnings cycle is now turning up. Inflation is now falling enough to take the pressure off profit margins. Looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth,
KB Home reporting soft gross margins. That conversation up next. This is Bloomberg.
The earnings cycle is now turning up, and it doesn't have really very much to do with the real economy. It's very tech-led. Inflation is now falling enough to take the pressure off profit margins, and probably the third and least important one is that the economy is sort of hanging in there. So looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth, and the Fed and frankly the rest of the world beginning to cut interest rates and keeping valuations high.
That was Ben Laidler, the global market strategist over at eToro. Shares of KB Home are under pressure despite reporting better than expected results. You heard Ben there talking about earnings growth. CEO of KB Home, Jeffrey Metzger, saying, "We're well positioned to navigate the potential for shifting housing market conditions and have started to increase our investment in land acquisition to support our commitments to grow our community count." Bloomberg's Abigail Doolittle is here with more on KB. Abby?
Yeah, absolutely, Matt. If we take a look at KB Homes, we are going to see that the shares right now are currently down about 4%. And this, of course, having to do with what you were just talking about. It also has to do, of course, though, Matt, with the quarter. I mean, the stock is really plunging on the soft gross margins and the orders miss. And there have been so many questions recently, Matt, in terms of mortgage rates, the 30-year fixed mortgage rate going above 30%, above above 7%, and that the idea that that could really crimp demand. It seems as though KB Homes is in fact seeing that. Barclays analyst Matthew Boulay is saying that the sequential order trends are in line with normal seasonality, but it's the fourth quarter guide that should be a little bit of a concern. At the same time, it could be as a trough, reflecting the orders from the weaker first quarter environment. But you take a look at the stock over the last year, Matt, and year to date, really up in a big way. So the fact that it's coming in just a little bit, is not so surprising given the weakness on the quarter.
Yeah, well, big beats we saw for the reporting quarter, right? In the third quarter, I think they had $1.80 of EPS. We were looking for $1.43. Beats on the revenue side as well. Abigail Doolittle on KB Home. RBC's Lori Calvasina weighing in on the outlook for earnings, writes, our EPS forecasts are moving up, which is unusual in years when they started out too high. Normally, consensus forecasts are stable after mid-year and don't move up this late. And Lori, I noticed something, in Ben Laidler's expectations that I see from a lot of people who are very optimistic about the economy, but also expect rate cuts. Can you really be both? Do we get, strong earnings growth and a thriving consumer, and then the Fed for some reason cutting rates? Why would that be?
I think that's a great question. I think that the Fed ultimately, and we heard a little bit about this yesterday, ultimately, does have a dual mandate. And so I think if we do see a little bit of, continued erosion in the labor market and inflation is already coming down and headed in the right direction, starting to get close to where it needs to be, I think they're going to have a very hard time justifying keeping rates as high as they've been. Our rate strategists have also talked about adjustment cuts. So, that gets a little bit more technical and behind the scenes. But I think goes to show that ultimately at the end of the day, whether or not they call it an official part of their mandate or not, the Fed is not ultimately, longer term at least, trying to derail the economy, even if they are, sort of willing to risk a recession in the short term. I will tell you, though, I think there are really interesting dynamics next year between earnings and interest rates and inflation levels. And, one of the things Laidler was talking about that sort of caught my attention was he was talking about as inflation come down, it helps, profit margins. And I think that's true to some extent, but I think we also need to keep in mind that as inflation comes down, it impacts revenue growth in a negative way. That's actually something we've got embedded in our earnings model. So very much, kind of our initial thoughts about next year are that inflation moderating, it's good for multiples. Ultimately, some rate cuts will be good for multiples, but at the same time, there's a negative impact on earnings. So you've really got to monitor the two cross currents simultaneously.
In terms of, I was thinking about this in regards to Japan, because they want to get on inflation before it gets too far out in front of them. But the problem with deflation is that you put off purchases until later. When you're looking at inflation, right, do you pull those purchases forward?
I think you can pull those purchases forward, but I think the other situation that companies have really been benefiting from is that when you have inflation, you pass higher prices along to your customers, whether those are consumers or other corporations. And we spent much of the last 2 years hearing companies say, hey, don't worry, we're going to go out and increase prices, and our customers get it because they understand the inflationary and cost environment, and they really can't argue with us. Well, guess what? That cuts both ways. Now that inflation is starting to moderate, we're starting to hear some companies talk about how that pricing environment is just frankly getting a little bit squishier. Some of them are declaring, hey, we can still pass through prices for while longer, but others are admitting that it's not going to be that easy. And that's where I think the rub on revenues really ends up coming.
All right, Lori, awesome to have you on the program. Thanks for joining us. Lori Calvasina there from RBC. Coming up, the market-moving events you need to be watching out for. That's next in our Trading Diary. This is Bloomberg.
about that all day yesterday.
This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Farrow. Time now for the Trading Diary, what you need to be watching this week. At the top of the hour, we're going to get existing home sales. And then on Friday, we'll get a BOJ rate decision. That could be interesting. The UAW's deadline to extend strikes is also noon Eastern on Friday, plus Fed speak from Mary Daly and Neil Kashkari. And finally, U.S. GDP is due next Thursday. So that's something that we can watch for on the economy. And coming up next, right now, today, in this very moment, the Bloomberg Global Credit Forum, John, Tom, and Lisa are sitting down with Jim Selter, Apollo Asset Management co-president, for an interview you do not want to miss. I'm Matt Miller. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome, everyone, to Bloomberg Markets. It is Thursday, September 21st. We almost made it. Here are the top market stories we're following for you. All right, hold is the new hike. The BOE follows the Fed and pauses. Bonds sell off, except at the U.S. front end. And Cisco Splunk. The shares are down at 3.5% after announcing a deal to buy Splunk for $28 billion, its biggest acquisition ever. And the credit event. We are going to take you live to Bloomberg's first ever Global Credit
Forum, where Jim Zelter, Apollo Asset Management co-president, breaks down the risks and opportunities. All right, Guy, we have this market here. We're looking at equities selling off a bit. We're looking at bonds definitely selling off, yields higher, except the U.S. front end, as we kind of wait for the next move.
Yeah, we're dealing with a hangover from the Fed, to a certain extent the Bank of England as well. Our question yesterday was, are we there? Yes. I think from the Fed's point of view, Alex, the answer is yes, but it depends on the traffic. We'll wait and see what happens. The Bank of England, I'm not even sure the Bank of England is using a map at this point. I don't think we know where the Bank of England is going, and that's the tricky thing there. Trying to figure out the Bank of England, a much more tricky story. Are we there yet? Who knows?
Yeah, no, that's very accurate. With the Fed, like, yeah, we're almost there, but it depends on the traffic. All right, well, let's get to some of the traffic, I guess, because this is the economic data that we're getting. We got continuing jobless claims coming in still solid, right? Let's get to existing home sales now with Michael McKee. Hey, Mike.
Well, one thing we're not doing, Alex and Guy, is going out shopping for houses here in the United States. Existing home sales fall by 0.7 on the month to just over 4 million at an annual rate. The forecast range was for 4 to 4.25. July was unrevised, and we can also tell you the month's supply is unchanged at 3.3%. Here's the part the Fed will pay attention to. Median home prices up 3.9% from last year to $407,100, even though the number of homes for sale has gone down. So at this point, it looks like supply and demand pushing prices up, but not a lot of demand.
Yep. This is all Alex's fault, basically. Yeah. Alex got a great rate. Everybody else got a great rate. Nobody wants to sell their houses because they got a great rate. The existing market is broken, Mike.
It does seem to be that way, and the question is, how long is it broken for? Is there a level of mortgage rates that will bring people back into the market? Certainly not the 7 or 8% we see now with the Fed where it is. How far do they have to cut before housing recovers?
Yep, and that is an excellent point. I guess you have to move because for a job or something else. Hey, Mike, thanks a lot. We really appreciate that. Taking a look at the equity market still, you're looking at NASDAQ 100 still down by about 1.4%. You are still seeing bond sell-off except the front end in the U.S. There you go. Housing starts slip, but expected, right? All right, well, now we want to take you to Bloomberg Surveillance Special in London from the Global Credit Forum. A great lineup for you. Definitely want to tune into this. You have Tom, John, and Lisa are joined now by Apollo's Jim Zelter.
Thank you, guys. Appreciate it. Live from the City of London. Home turf for me, no secret, my favourite city on the planet. And I can say that because we've got a home audience. Good afternoon to you all. A special edition of Bloomberg Surveillance from our Bloomberg Global Credit Forum. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. TK, we couldn't have planned it any better, could we?
Yeah, they came to me like 6 months ago. Julie had her people call me up, and Julie said, we got to do this panel. I said, I don't want to do it. And I said, okay, we're going to do this panel, but we need some theatrics. So she said, look, if we can arrange the Fed and the BOE, particularly the BOE, 5-4 decision to blow up the bond market over 48 hours, we could probably get Zeltner. And that's how this started.
Let's get the 2-year something close to 520, a 10-year up to maybe 450.
Yeah, but the problem is that the volatility, as Jim was saying, is all in the 2-year, the 10-year, the 30-year. It isn't in the credit market, which is what you would expect. And people have been wondering when will it actually matter for the fact that it's getting more expensive.
Yeah, it's real sophisticated. Yield up, price down. Price down means assets are challenged. I don't care what flavor you have here of the ice cream of the fixed income market. The answer is coming out of this, dare I say what BOJ does tomorrow, we've got moonshots in certain series, and what I'm focused on more, and this is my first question to Jim, is going to be the 10-year real yield.
We're all living this right now, and I think slowly over the last couple of months and then quickly internalizing that high for longer message across various central banks, but particularly the Federal Reserve. We're internalizing that increasingly, Tom. We're seeing it in the Treasury market. Risk assets really resilient in the face of all of this. You're talking about real yields, real and nominal, near cycle highs, and risk assets just pretty steady still.
There's no question about that in the last 18 months, but I'm going to go to the memory of Jim Curry out the door at Goldman Sachs, and Jim Curry and hydrocarbons there. He said, look, the real yield changes. It affects everything in the real economy, including all the investments of Apollo, really everything out there. There's no question.
Jeff Curry's not in the audience.
Jeff, he is not
this afternoon.
Here.
Okay.
Excuse me, Jeff Curry. Excuse me.
Jeff Curry.
It's late in the day. I did an all-nighter last night.
We're only 3 minutes into this.
There's plenty of time for more.
Do you want to bring in the guest?
I'll bring in the guest right now. This is fun, and it's really fun given where the markets are. I played lacrosse at Duke University, and I went back and I looked at the first day that Jim walked into Apollo, and the real yield's about back to where we were in 2006. We've come full circle. First of all, what was the first day like at Apollo, and what does it mean that the real yield, the 10-year real yield, is now back to where it was in 06, 07?
Well, first of all, thanks for inviting me today. I'm excited to be part of this great road trip. You know, taking you back down memory lane, Apollo was a much smaller business back then. We were probably 20 billion in assets. We're 650 today. The role of banks was much different. There was a massive risk appetite at that time in the world. But certainly if you go back, I think the world was very different. And I guess I would start out today saying, as you guys talk about, you know, where real rates are, basically what you're really saying is the cost of capital has gone through a massive reversal. And so all the activity going on in the last 18 months between all the central banks of the globe, that was the mechanics of getting to this destination. But now we have the rebalance, we got out of balance. For 10 years, debt was priced way too cheap. And you were forced to go into equities, and basically debt subsidized a massive amount of equity returns. And so the last 18 months, you know, the world now has about 300 trillion in debt on 100 trillion a global economy. Those numbers are up basically doubled in the last 10 years. And when you go from 0 to basically 4 or 5%, that's 10 trillion of borrowing costs that have to be absorbed. And so there's a massive balance going on between debt versus equity and versus balance sheets. So,
folks, we're going to turn this into a 2-hour seminar, given where the markets are. We're arguing about that.
I'm not sure they want this to become a 2-hour seminar.
The answer is I'm going to let Lisa and John do the heavy lifting here. I got one more question, which is the memory of 1998, which was about leverage in the system. It was about shadows in the system. Now that we're back here, and with the first and second derivatives of how we got back here, where are the shadows now?
Well, certainly wherever there's an asset liability mismatch, SVB was a perfect example of that. People talk about regulation. It was just a simple, not how you operate a financial services business. Where are there ALM mismatches? You know, certainly I don't think it's in the world of private credit. I think it's probably a lot of consumer finance challenges around the globe right now. You've got way too much public debt right now. There's challenges. So there will no doubt be challenges over the next 24 to 48 months as you've got fund companies that have funded debt-laden balance sheets of companies that have funded growth CapEx, and they cannot pay the piper right now.
Everything you said in your opening remarks is what Lisa wrote about for the best part of a decade, right? Complaining about the previous regime. We're all trying to figure out if this is truly a new regime or just a moment in time that we move away from pretty quickly. Can we live with where real rates are right now? Can we live with that?
Well, I think that it's sort of reality. We're getting back. You say real rates. I say cost of capital. It's cost of capital for everything we do. If you think of the last 10 or 15 years, the growth of technology companies, the growth of biotech, there's some great companies out there, but they were funded with the equity had all the benefit, and the zero cost of debt is not really sustainable. So this is the real world right now. Real rates are going to be higher. The cost of capital, as we go back to this balance, and I don't think it's a surprise this week, as we were talking about earlier, the FT op-ed by the two finance ministers of France and Germany talking about the European financial services sector and the role of banks. So there's a parallel path here, conversation about how companies finance, how they have access to capital, the role of savings and securitization. So it really is all tied together.
Although, are we really living with rates where they are? I mean, we take a look at these average rates, we see them in the numbers, but that's not what anyone's actually paying. Companies have already termed out their debt. So are we living with it, or are we going to see what it looks like to live with it in a year?
I think we're not seeing it. So to highlight that comment, the mechanism, the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. In the U.S., you have a mortgage market with 30-year mortgages at a 3% interest rate. You have the high yield market with a 6% coupon and an 8-year duration. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical. I see a world where financial conditions have gotten tighter, and it's just a question of how long that transition mechanism, which will probably be longer than it's taken in the past.
There are a couple different ways for us to get to something other than a soft landing. There's the crash and then rates going back down. And then there's something where it's just sort of a stagflation light or a stagflation proper, where rates remain high for a very long time and growth just slows substantially. It seems like the market is leaning into the latter. How much does that change your perception of what's going to happen in the credit space?
Well, this conversation is going into one where we need to get Torsten here because he's the economist at Apollo, not me. But certainly what you're talking about is an environment where growth is more challenged, and with, how do companies access capital with a new price of marketplace? Certainly you have challenge, whether it's in Germany or in the UK, with a slowing economic growth, but there's a variety of aspects that we would see. Unemployment, while still very low, it's going in probably a more challenging direction. Delinquencies are going up. Defaults are going up a little bit in the leveraged loan market, in the high yield market. Recoveries are lower. So there's a lot of points that would say to you that there's going to be a more challenging, tightening financial conditions. But certainly for us, the U.S. has been quite strong. The UK, there's still a lot of areas to lend. There is on Western Europe as well. So I guess the theme that I would take away from this is that we're going from a decade of a real imbalance where the equity was the big beneficiary, debt paid a crazy price. That balance has been completely changed 180 degrees. And now, how do companies navigate? How does the financial services, how do banks, how do alternative asset managers, how do we all balance and navigate this marketplace ahead of us?
Is this the return of the bond vigilantes then?
Well, I do think when people talk about, when the central banks are going to actually lower rates, I think it will happen well before they actually get around to it, just like it happened on the upside in terms of rates. There's no doubt that one of the challenges of the last 15 years of the regulatory environment is you've had so much capital withdrawn from these marketplaces in terms of trading desk capital. So the amount of capital to trade $100 or $1 billion of 10-year treasuries right now, that has a greater impact. So there's no doubt that any kind of activity in the secondary markets will have a pronounced impact. And that's just the way of the regulatory impact post GFC. But for us, if you're in my seat at Apollo, there's been 4 trends since I got in the business. There's been massive technology improvement, there's been massive globalization, there's been massive deregulation, and the 4th, there's been a decline of interest rates. Other than technology, you're probably having those tailwinds be massive headwinds as an investor now. So how do you navigate that? How do you organize yourself? But I do think in terms of investors, it's a time to be
The technology change is the Bloomberg terminal. In case you didn't.
Everyone needs a Bloomberg terminal. Is that the pitch? We're done.
Yeah, that's the pitch.
That's the pitch.
Okay, we're done.
Earlier in the conversation, Jim mentioned that joint op-ed that was in the Financial Times. The headline, for those of you that didn't read it, "We must close the EU capital markets gap." Can you talk to me about how Europe goes about doing that? Because me, Tom, Lisa, this whole audience has heard that 1 million times in the last 10 years. How do we close that gap?
Well, I think, let's talk about how we got here. We got here post-GFC, where a lot of tools that have been used to push risk out of the banking system that I think have been successful in some regions of the globe, the European regulators took a different view. They took a dim view of securitizations. I would argue that if you look at securitized product, that's actually been very good for the banking system in aggregate. It's pushed risk out to the real owners of risk. If you look at other things that they talk about shareholder activism, but I do think there's got to be an embracing of these types of tools to allow greater activity, because I think it's creating a bit of financial services stagnation.
Torsten Slot called me up one day and he said, you really ought to look at the Austrian piece. So I loaded the boat on a 97-year Austrian bond. That really has worked out well. I'm down like 70% or whatever. Tell me about what duration's going to do and choice of duration is going to do given this new environment back to 06, 07, 08.
Again, when I think about the world, I think about long duration, but what we do at Apollo is we're really trying to figure out places where we're not taking credit risk or duration risk. I'm just creating great spread. So whether it's fixed income replacement, I certainly believe that the world has been on that textbook of if you want to make money in fixed income, you got to do duration. I think it's an interesting way to look at the world. I think you're getting paid right now on risk-free rates to some degree, whether they go a little bit higher or wider. I certainly know for us at Apollo, whether it's in the investment grade world, public and private, whether it's in private capital, when we can make high single digits, 10%, being a lender, that's a great business.
Do you hedge into that? I mean,
we do. Our business, most of our business is unlevered, but if we do have any kind of leverage in our business, we match ALM, complete asset liability matching all the way through.
So what's better for you now, right? Private or public? You said that private is sort of immune, and yet a lot of people think it's just not traded, so you can't see some of the carnage that you see in some of the IPOs of ARM and Instacart. So what's your view there?
Well, I think certainly if you look at an aggregate, it's hard to make money in the public markets and as an aggregate statement, equity and debt. Certainly with the valuations where they've backed out in terms of where rates are right now, a risk-free rate, yes, there's some opportunities in the investment grade world. But if you look at high yield indexes and leveraged loan indexes, they're arguably rich. They're rich for a lot of technical reasons. And so our ability, again, when we talk about private credit, most people, and you talked about earlier, they talk about really the sponsor finance market. Right. The reality is, whether it's inventory finance, trade finance, solar finance, there's a massive $30 to $40 trillion opportunity in terms of the TAM. So that's where we're spending most of our time, creating great, safe spread yield really on investment grade companies.
This sounds like a bank.
Well, I would say is we are a credit lender. We provide credit, and we do it in a manner where we're not using a balance sheet that we can lose deposits tomorrow. We have long tail liabilities, and we match those.
A lot of people have said, particularly in the banking sector, they're going after their lunch, and that they have to follow pretty significant regulations, and you don't have to, and you have fixed capital. Yeah. And it's kind of what it sounds like in terms of the size and the scope that you need to achieve. It's kind of taking on a lot of the functions that banks used to fulfill. Is that the business model right now?
Well, I think our business model, so if you look at our $650 billion today, $350 billion comes from retirement services balance sheets, fixed annuities. The other half is the GP model. We're able to lend money to Air France, to Vonovia, the big German real estate companies. We can do that in a manner where we are solving the company's problems, and many times we're doing it in conjunction with a advisor or a bank. There's a narrative out there that we win, the banks lose, or vice versa. The reality is we are doing more in collaboration than we've ever done before. We have a big venture with BNP and inventory finance. They've got an amazing franchise. We partner with them so they can manage their capital in a more efficient way. But the reality is there's more collaboration. And people say, are you frenemies? Are you opponents? Are you competitors? It's all the above. We work very closely with them, and they work closely with us.
Should we make some news? There was a headline yesterday, Apollo looking to raise about $2.5 billion to lend in private markets, according to people with knowledge of the matter. We're talking to someone with knowledge of the matter, maybe. Are you looking to raise about $2.5 billion to lend to private markets?
You know, we're an active player in the extension of senior loans to sponsors. We're active in many of these businesses. We've got a $425 billion credit business. The fact is, we built this business not expecting real yields and absolute yields to be at these levels. We thought it was going to be lower for longer. We created all these origination platforms. So the reality is today, investors around the globe are clamoring and they're saying, wait, on a risk-adjusted basis, we can do this in the credit markets or in the debt markets. Why do we need to take that equity risk? And I think that's why you're seeing a preponderance of conversations about from sovereign funds to foundations to pensions around the globe saying we can make what we had to take equity risk in the past, we can do it on the debt side of the balance sheet.
I think that's a yes.
Was that a yes? Was that a yes, Bram?
I think so, yeah.
You are looking to raise $2.5 billion.
We're raising we have a large platform. We're one of the handful of great players in the world. We're raising.
Wait, how does that work? Do you make like 6 phone calls? I mean,
you know, I travel quite a bit. If you ask my family, I travel a little bit more than those 6 phone calls. But we have several thousand LPs around the globe, and my schedule could be packed up going to visit them.
I can see Apollo PR right now. Jim, you were not meant to say yes. Just keep talking. Don't answer the question. Jim, let's go back to spring. Spring was really messy. Banks failed in America. Yeah. And I remember sitting there, and we had guests come on the program with us on Bloomberg Surveillance, and lots of guests said, we've started a process here. It's the end of the cycle. There's going to be a hard landing. It's only several months ago. What was that?
I think it was an expectation of what was happening at that moment was going to happen completely. And the reality is this is a big, broad global economy. The consumer plays a massive role in it. Back to my comment earlier about 3% mortgages on 30 years. The U.S. consumer really has not, we may have taken rates up, but the real impact of this higher cost, the second, the third derivative, it's early still. It's really early, and I think that's the difference between, there is no doubt the health of the U.S. consumer is what's allowed us to extend the economic cycle, but I think they're eating through some of their savings, and there's no doubt that there's the tightening of financial conditions is going to be out there, and we're finding more companies coming to us trying to solve their financing needs going forward.
There are other firms challenged because they decided they were going to go off and do something different, new, original, and they're selling things for a haircut. You're probably involved in those transactions. How do you avoid worst practices? You guys have grown this thing from next to nothing. Mm-hmm. The private world is in right now. You're doing a brain drain. You're taking all the smart guys from Wall Street over to Apollo. Everybody knows the ballet. How do you avoid the worst practices we observe every day on the show where things blow up for Wall Street?
Well, the biggest accident you can do as you grow is to offer people liquidity on illiquid assets. And so I don't think it's a surprise. We're not in the business of offering daily liquidity in any of our products. We run our products, we really match the assets to the liabilities, and again, I think that's really a core to how we run our business. The second is, for the last 6-7 years, we've continued to go senior in the capital structure. We're doing more investment grade companies, we're doing larger companies. Witness what we've done with, as I mentioned earlier, Air France or AT&T or Vonovia, big quality companies. So also, when we underwrite something, for the most part, we bring in partners. We want others to take a look at what we've done. We're really good at underwriting credit risk. We brought a lot of that credit oversight that is so valuable at many of the financial institutions. But we have to make sure we're really measured and we focus on the three businesses that we're in right now.
Jim, what are you doing with the books that you already hold of debt and equity that is valued much lower?
Yeah.
I mean, it's one thing to talk about future lending opportunities.
Sure.
What about the ones you already did?
Well, let's talk about our business. So today of the $600 billion, equity is around a sixth of our business, about $100 billion. We've been very, very clear in our private equity business in our flagship vehicles to fund more so with fixed rate debt and really extend those maturities. For the most part, we have been really not levering to the max. If you could lever companies 5-6 times, we typically borrowed about 3 to 4 times. So we didn't borrow as much, and we did it for term at fixed rates. That's a really important. What we learned in 08-09, it wasn't we were the smartest guys in the room, is that we had the best capital. And if you had the best capital and didn't get pulled away from the table, that's usually a critical aspect of success.
That takes us to our final question to wrap things up with you, Jim. In a world of high uncertainty and low confidence, do you have a high conviction call looking out in this market right now?
Well, I think that you have to assume, I think there's going to be what we call some big fat pitches out there. The reorganizing and the restructuring and the refinancing of the entire CRE universe. You have to be marshaling resources around that. You have to make sure that if you are lending capital today, you're doing so on senior basis with a tremendous amount of equity underneath you. So for us, I mean, certainly we're in 3 businesses. We've been very, very disciplined about what we've done. We have had a lot of human capital. It's been amazing for our company to pivot and grow, but really to make sure that we stay true to our alignment, our risk-adjusted returns, and making sure that purchase price does matter. We are very focused on the creation value of our businesses.
Man, you lost last night?
Is that what happened against Bayern Munich?
Is that an opportunity?
Is that an opportunity, what, to go to the Glazers? And
Yeah, they lost to the
club?
Harry Canes. So
You really are trying to make some news.
Yeah, I'm trying to make some news.
Do you want to buy a football club?
You know, we have an active we have an active lending business, and we've done a variety of things in the world of sports entertainment. But we really are.
That's a no this time. I think that's a no.
Yeah.
Can we have a round of applause for Apollo's Jim
Thank
Zelter? Jim, thank you. Thank you very much. And thank you to all of you for joining a special edition of Bloomberg Surveillance live from the City of London. Thank you to you all. I'm going to throw it back to New York.
You've been listening to Bloomberg's Global Credit Conference. Tom Keene, Jonathan Farrell, Lisa Brahmas, just speaking with Jim Zelter, co-president of Apollo Asset Management. Super interesting guy when you just take a look at sort of where we are now and where we're going. And there's clearly, guys, so much capital waiting to be deployed at the right time. And finding that in a higher for longer environment is going to be fascinating.
Absolutely, but we're going to find it in the private markets. We're not going to find it in the public markets. Public markets are a tough place, according to Jim, to make money, and I think that's interesting. He talks about kind of what is happening as well with credit indexes and whether or not they're really reflecting reality at the moment, certainly the reality that he sees. So yeah, he sees some great opportunities in front of them. He thinks it's going to be very much in the private markets, but that has been a trend that we've been watching for really quite some time. He is partnering. The business is partnering with a range of individuals at the moment and a range of businesses as well. It was interesting, he highlighted some of the co-ops, so some of the cooperation that is happening with the banking sector, often seen as being antagonistic, maybe less so in Jim's mind.
Yeah, maybe working together a little bit. Seeing some opportunity in the CRE lending space. They're lending more to IG companies. So we're really interesting to parse through. Let's get to it with Bloomberg's Sonali Basak and Claire Boston. They join us now for some of the takeaways. Hey, Sonali, you cover what these guys are doing very closely. What stood out to you? What was differentiated?
Listen, Apollo has been one of the biggest beneficiaries of the shrinkage of the banking system. When we asked some of their executives a week ago, they said, you know, we're not dancing in the streets, we're dancing with the banks. So the point that Guy is making with the syndicated markets facing trouble, and especially in some of the riskier parts of the market, you have seen Apollo and its rivals step up for record-breaking deals. Now, one thing that's interesting that Jim was talking about was where do you start to see stresses in the market? I think back to a conversation I had with the incoming CEO of Oaktree just a couple of weeks ago, and the point he made is deals, even in private credit, that were underwritten in the years through 2021 in the boom times could still start to face some stress. But if you believe what Oaktree and Jim Zelter believe, which is that the next 24 to 48 months, 1 to 2 years, could be stressed in the market, then all of a sudden you see the Oaktrees and Apollos of the world start to step up and provide what was previously seen as rescue financing. These are your lenders of the future. The banks can be there as much or as little as they want, but at the end of the day, it's all of this dry powder. You put that $2.5 billion that Apollo is raising into perspective, that's less than 0.5% of their overall credit assets. So there is room to run there.
Claire, it's interesting. We talk about this distress cycle. When is it going to happen? Because that's the other point as well is, and he highlighted this, the economy has been much stronger, particularly in the States, than any of us anticipated.
Right. I mean, one thing that really struck me is ultimately, I think his tone was pretty bearish. You know, he is very skeptical that the Fed can really engineer a soft landing. And he's also not really sure that unemployment, you know, he thinks it could get worse. You know, those are pretty ripe conditions for more distress. We're seeing a lot of companies struggle with rising rates. So, you know, if we are in this sort of higher for longer space, you know, there's definitely a lot of people forecasting an uptick in the next, as Sonali was saying, 24, 48 months.
Yeah, I mean, we also call that like talk in your book, because obviously all the distressed guys want the distressed cycle to come so they can put money to work, Claire. And I'm just wondering, you know, when you talk to your sources, like how much money is really sitting on the sidelines to invest in this space? And if that's the case, does that prevent the cycle from actually happening because there's so much money?
Yeah, I mean, I think it's one of those things, people will say that we're being opportunistic and, you know, they're really looking for those rescue financing operations, you know, really lending at these high rates. But that being said, we see the markets are really open right now, and that, I think, is a sign that investors are willing to put at least some money to work in this market.
Sonali, one of the things that we have been constantly monitoring has been the evolution of the private markets, and they get bigger and bigger and bigger, and the scale is just becoming eye-watering. Is the real challenge actually less what the credit cycle is going to look like, where the opportunities are and aren't. But the fact that regulators are increasingly going to be paying attention to this side of the business in a much more clear-sighted way.
They keep saying so. You think back to multiple administrations, and they have said that they would take a bigger look at the non-banks. But if you look at that non-bank kind of space here, you look at Apollo with less, or give or take, $500 billion in assets, and you take a look at BlackRock with some $10 trillion in assets, and what the private market guys will tell you is that why are you looking at us before you're looking at them? So that space in non-bank is a large one. By the way, all of these folks are taking share from the banks as the banking system not only shrinks, but is regulated more and more and more. Think about it. Money market funds these days are an ultimate source of repo financing, overnight financing to hedge funds that are levered to even just treasuries 50 to 1. So the non-bank space is large. But to your point, there's a lot of risk still in that system as well, and it's unclear how that shakes out.
Well, yeah, and also it's just a matter of when it shakes out, does the regulator, glass just move to them? Because there's so much money in the private market, at some point, the regulators will come knocking.
Let me give you, for example, UBS thinks that the default rates will peak next year in the private markets at 10%. That tells you that there is a significant amount of stress still there. But that 10% may just not break the bank. And so if you get to a 10% default rate and you kind of make it through alive, where is the risk? I think that is the question. How much money do you really lose in that scenario, and who loses it, I think, is the main question.
Claire, Jim's biggest conviction call, restructuring CRE, commercial real estate. How big is the scale of the opportunity there? How big is the opportunity in terms of making money? How selective are you going to have to be? He sees that as his big conviction call. Is that what you hear from others? Is this where everybody's expecting to hunting already? How is it working?
I hear a lot of fear in that space right now, specifically when we're talking about things like Center City office, just not a lot of conviction from investors about where we go from here, return to office, all these trends.
Is it a surprise that therefore it's his biggest conviction call?
I have to say, knowing, just in general how Apollo works, not at all. They're looking for opportunities where they can really step in and make some money, lend at these really high rates. And we're just seeing this huge uptick in distress there. WeWork, for example, is trying to renegotiate all their leases and threatening that they may have to file for bankruptcy. So if you're someone like Apollo, there's probably a lot of opportunities right now.
Hey, listen, guys, really appreciate it. It was a really interesting conversation. There's obviously more from the Global Credit Forum as well. Bloomberg Shanali Bassick and Claire Boston, thank you both so much for helping us break it down. So we are, though, about an hour into U.S. trading session. It looks like an ugly day is unfolding, particularly when it comes to tech. Abigail is tracking some of those moves for us. Abigail?
Yeah, Alex, it is certainly a heavy day here for U.S. stocks. The S&P 500 down about 0.9%. You can see the NASDAQ 100 down even more. The NYSE FANG index, those mega cap tech stocks down closer to 2%. And then the Goldman most short, non-profitable tech, and I think highly shorted technology companies down closer to 4%, having to do, of course, with yesterday's Fed meeting. The message of higher for longer not resonating well, even though I don't think it should be much of a surprise. I think that this Fed has been very transparent in terms of their goals, in terms of wanting to hike and make sure things are not going to turn back into the 1970s where inflation could be sticky. So the idea of money coming out of the system weighing on stocks. We're looking at a third down week for stocks in a row. If we take a look at the NASDAQ 100 so far this week, and actually this is that look at the 3 weeks, so you can see it's been kind of hanging in there, but this is the week, the Fed week. This turned out to be the directional break, taking the NASDAQ 100 down 4.5%, really breaking that uptrend that we looked at yesterday. As for yields, this is pretty incredible. The 2-year yield right now down about 5 basis points, but about at 5.13. This could make some opening on the day for some sort of a move, a reversal. I wouldn't be entirely surprised just based on the way things feel if we these gains, these losses, I should say, lessen, or we even reverse higher. I don't know, obviously, that that's going to happen, but this could create that window. On the other hand, take a look at the 10-year yield, 446, 450 seems pretty likely. And technically, again, the other day we talked about the idea that the equal and opposite move up from the range could produce a move back above 5%. As for the S&P 500, we have been very patiently watching this range over over the last couple of weeks. And you can see here, this is how ranges work, that when you go off the top of it, the seller's very predictable. You can also see that the buyers, those lower highs, they weren't willing to buy at a higher level, guys. So now we're below the 100-day moving average. We're almost at the floor of this range. The RSI is rounding down. Ranges themselves are not all that interesting. It's a battle between the bulls and the bears as they're looking for information. We got some key information from the Fed yesterday. Again, not necessarily new, but a reiteration, a confirmation of the idea that the Fed is still very much in place for a potential hiking mode. This range will break up or down. Right now, it might be a little bit more toward the side of breaking down, which could create an interesting fall for stocks. Potentially.
Oh, yeah. Potentially. It's always potentially. The battle between the bulls and the bears. Abigail, thank you very much indeed. We've all been confounded in terms of our expectations for this year. So let's get back to our question of the day. Actually, it's a two-day question of the day. We just kind of altered it, upgraded it, improved it maybe a little bit. We've just seen the Bank of England take a pause on its aggressive cycle of rate hikes. It did 14. Is it done? To be honest, I think we're all struggling to understand the reaction function over at the Bank of England. The Fed a little clearer, maybe easier to understand in terms of the navigation, signaling it is close to being done with rates. But as we've seen with the data today, the claims numbers, the economy continues to be strong. The labour market continues to be strong. So given what we've just learned over the last 24 hours, our question has evolved. So now, are we there yet? I think the answer is different depending on which central bank you are looking at. Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager, joining us now. Joanne, in terms of the destination, in terms of where we're going, in terms of whether or not the central banks are there yet, what do we learn over the last 24 hours? What did you learn?
Well, not much, Guy. I mean, the Fed did what we expected it to do. They said we're going to keep rates here for a while until we get more data. And we may need to keep them higher for longer than y'all think. And the new dot plot coming out of the independent, right, the regional banks said that they don't expect as many rate cuts as the market did before yesterday. And that was really the surprise for a lot of investors. We've been...
To be fair, I mean, they pared back their cuts too. So it wasn't just the market, it was also the Fed paring that back. Like, is that what the market's reacting to today? Is it the pricing out of cuts?
Yeah, that's what I meant, Alex. Sorry to be unclear. Yeah, the Fed's dot plot showed fewer cuts next year, and that surprised investors to some degree who've been really on the optimistic side of, hey, the Fed's going to stop this soon, and they're going to cut rates, and they're going to have to stimulate the economy. And that's clearly not what the Fed sees, right? The Fed sees inflation pressures remaining and that they have more work to do. And investors really need to understand that there's still a lot of uncertainty about how many more times rates are going to have to go up before inflation is permanently under control and headed back to 2%. We've made a lot of progress, but we're not there yet, and that's what the Fed keeps telling people, and they need to believe it.
We're just getting some commentary coming through from the Governor of the Bank of England, Andrew Bailey. The good news on inflation prompted a pause in rate hikes. It's premature, though, to start talking about rate cuts. That sounds like a central bank that is done, but seems to have been pulled and pushed by the CPI data all over the map recently. Joanne, I think we're over here struggling to understand the reaction function, the direction of travel for the Bank of England, at least at a kind of easy to understand level. The Fed seems a little more understandable. It's got to where it is. It's kind of looking around. It wants to figure out what happens next. Do you understand the messaging clearly that the Fed is trying to give us?
Yeah, I think they've been pretty clear. They've said, they've tried to elucidate the drivers that they are most concerned about for structural inflation, that the super core, if you like, right? The core services ex housing, because they can see what's happening with housing, right? The price increases there have dissipated. Gasoline prices are up. That's certainly not helping the headline target. But overall, it's the wage side of things. That's the key. And as we continue to get strong labor market data, I mean, labor market's loosened a tiny bit, but look at this morning's, claims numbers.
Yeah.
There's not a lot of loosening going on in the labor market. And that's what the Fed is really focused on. I think they've made it pretty clear that they're watching the key drivers of inflation and that they need to keep being data, focused to try to make sure and to keep expectations anchored that they are really committed to the 2% target. And a lot of people have, started to question that, and I think that's inappropriate. Yeah. From the stock market perspective, it's also about earnings, and earnings forecasts have changed a lot.
And funnily enough, I mean, we all like Mike McKee's question where he basically asked Jay Powell, do you believe your own forecast? Like, how do we believe you? Do you believe it? To that point, do you need to buy tech here, or can you still sell it based on all the macro talk that you're looking at?
It really depends on your investing horizon, Alex, right? I mean, if you're a long-term investor, if you're trying to build your wealth to be positioned for retirement in 5 or 10 years, right, or whenever, you need to own tech, because technology companies are the ones that are going to be growing. They're selling into markets that are expanding. They're reflective of the changing demographics of the world, right? All of these things, whether it's AI or an aging population affecting